Something extraordinary just happened in the silver market that almost nobody is talking about. While everyone's been distracted by the headlines, silver quietly reached a critical inflection point that could determine whether we're about to witness one of the most explosive moves in precious metals history, or if this entire rally is about to come crashing down. And here's what makes this moment so dangerous. The next move could happen faster than most investors can react. Let me show you exactly what I'm seeing, because the technical setup right now is unlike anything we've witnessed in years. Silver just tested a level that's been absolutely critical going back multiple cycles, and the way it's responding to this test is telling us everything we need to know about what comes next. But before we dive into the charts, you need to understand the forces that brought us to this exact moment, because this isn't just about lines on a graph. This is about a fundamental shift in how the entire precious metals market operates. Think about what silver has done over the past year. We've seen a rally that caught nearly every analyst off guard, pushing through resistance levels that were supposed to be impenetrable. The metal surged through barriers that had held for years, and it did so with a conviction that suggested something much bigger was happening beneath the surface. But here's where it gets interesting. That entire move brought us right to the doorstep of a decision point that's been building for decades. You see, silver doesn't move in isolation. It's connected to a web of industrial demand, monetary policy, geopolitical tensions, and supply constraints that all converge at specific price levels. And right now, we're sitting at one of those convergence points. The question isn't whether silver is going to move from here. The question is which direction and how violently. Let me paint you a picture of what's happening in the physical market right now, because this is where the real story lives. While paper traders are pushing prices around on the COMEX, something completely different is happening in the world of actual metal. Refineries are running at capacity. Mints can't keep up with demand. And the spread between paper silver and physical silver has been widening in ways that suggest a disconnect that can't last forever. I was talking to a dealer last week who told me something that should concern every investor paying attention to this market. He said the premiums on physical silver coins and bars have stayed elevated even as the paper price has consolidated. That's not normal. Usually when prices pause or pull back, premiums compress as demand cools. But that's not what's happening. Physical buyers are still paying up, which tells you they're not trading this metal. They're accumulating it. And they're doing it because they see something coming that the broader market hasn't priced in yet. Now, before we go further, I want to make sure you're getting the full picture here. I put together a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their savings from everything we're about to discuss. It's in the description below. No cost, no obligation. Just solid information that could make a real difference in how you approach the months ahead. All right, let's talk about the technical setup, because this is where things get really fascinating. Silver is currently dancing around a support level that's been tested multiple times over the past several months. Every time the metal has come down to this zone, buyers have stepped in aggressively. But here's what's different this time. The buying isn't as immediate. There's hesitation. The market is testing whether that support is still solid or if it's about to give way. If you look at the chart structure, you'll see a pattern that's played out in silver markets throughout history. It's a consolidation phase that follows a major rally where the metal essentially catches its breath before making its next big move. The problem is, these consolidation phases can resolve in either direction. They can be launching pads for the next leg higher, or they can be distribution zones where smart money exits before a larger correction. So how do we know which one we're dealing with? You look at the underlying fundamentals, and you watch how the market responds to key levels. Right now, silver is holding above its major moving averages, which is bullish. But it's also failing to break through overhead resistance with any conviction, which is concerning. It's stuck in this no man's land where neither the bulls nor the bears have full control. Let me tell you what happened the last time silver was in a similar position. It was several years ago, and the metal had just completed a significant rally that took it from deeply oversold levels to a point where momentum traders were getting excited. The technical setup looked almost identical to what we're seeing now. Silver was consolidating just below a major resistance level, and everyone was debating whether it would break out or break down. What happened next caught most people by surprise. The metal chopped around for weeks, frustrating both bulls and bears, before finally making a decisive move. And when it moved, it moved fast. The breakout, when it came, added significant percentage gains in a matter of days. But here's the key. The move was preceded by a period of accumulation where smart money was quietly building positions, while retail traders were losing patience and exiting. That's exactly what I'm watching for right now. Are we seeing accumulation or distribution? The answer to that question will tell us everything we need to know about the next major move. And there are specific indicators we can watch to get clues about which way this is going to resolve. First, look at the volume patterns. During the recent consolidation, we've seen volume dry up on down days and pick up on up days. That's a bullish sign. It suggests that sellers are exhausted and buyers are still engaged. But we need to see that pattern continue and strengthen for it to be meaningful. Second, watch the behavior of the commercial traders on the COMEX. These are the big players, the ones who actually use silver in their businesses or who have the capital to move markets. Their positioning in the futures market can give us insights into where they think prices are headed. And right now, their positioning is showing something interesting. They've been reducing their short positions, which historically has been a bullish signal. When the commercials cover shorts, it often precedes a rally. Third, pay attention to the gold-silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold, and it's one of the most important metrics in the precious metals market. When this ratio is high, it means silver is cheap relative to gold. When it's low, silver is expensive relative to gold. Right now, the ratio has been compressing, which means silver has been outperforming gold. If that trend continues, it's a strong bullish signal for silver. But here's where the story gets even more compelling. Let's talk about the supply side of the equation, because this is where the long-term bull case for silver really comes into focus. Silver is unique among commodities because it's both a monetary metal and an industrial metal. It's used in everything from solar panels to electronics to medical devices. And the demand from these industrial applications has been growing steadily, even as mine supply has struggled to keep pace. The solar industry alone is consuming silver at a rate that would have been unthinkable just a decade ago. Every solar panel requires silver for its conductive properties, and as the world transitions toward renewable energy, that demand is only going to increase. Some estimates suggest that solar demand for silver could double over the next few years, and that's just one sector. Then you have the electronics industry, which uses silver in virtually every smartphone, computer, and electronic device manufactured. As technology advances and the Internet of Things expands, the amount of silver required for these applications continues to grow. And unlike gold, which is mostly recycled, much of the silver used in industrial applications is consumed and not recovered. It's gone forever. Now layer on top of that the monetary demand for silver. Central banks around the world have been accumulating gold at record rates. And while they're not buying silver in the same way, retail investors and institutions are. Silver ETFs have seen significant inflows, and physical demand from retail buyers has remained robust. People are waking up to the fact that silver is dramatically undervalued relative to its historical relationship with gold, and they're positioning accordingly. So you have this situation where demand is rising from multiple sources, supply is constrained, and prices are consolidating at a critical technical level. That's a recipe for a major move. The only question is timing, and whether the market can hold this support level long enough for the fundamental story to play out. Let me share something with you that most people don't understand about silver markets. The price you see quoted on financial websites, the spot price, is largely determined by trading on the COMEX futures exchange. But the COMEX is a paper market. It's a place where contracts representing silver are traded, but very little physical metal actually changes hands. The vast majority of contracts are settled in cash, not metal. This creates a situation where the paper price can diverge from the physical price, especially during times of stress. And we're starting to see signs of that divergence right now. Physical premiums are elevated, delivery times are extended, and there are reports of tightness in certain segments of the physical market. This suggests that the paper price might not be reflecting the true supply-demand dynamics of actual metal. What happens when that divergence becomes too large? Eventually, something has to give. Either the paper price adjusts higher to reflect physical reality, or the physical market breaks away from the paper market entirely. We've seen glimpses of this in the past, during periods of extreme stress, and it's always resulted in explosive moves in the price of silver. Think back to what happened during the financial crisis. Silver initially sold off along with everything else as investors scrambled for cash. But once the dust settled and people realized the implications of the massive monetary stimulus being unleashed, silver went on a tear that took it from single digits to nearly $50 an ounce. That move wasn't driven by industrial demand. It was driven by monetary fear and a loss of confidence in fiat currencies. Could we be setting up for something similar? Look at what's happening in the world right now. Geopolitical tensions are at levels we haven't seen in decades. The global monetary system is under strain as countries move away from dollar dominance. Debt levels are at all-time highs across developed economies, and central banks are trapped between fighting inflation and supporting economic growth. These are exactly the conditions that have historically been bullish for precious metals. But here's what makes this moment different from past cycles. The industrial demand story for silver is stronger than it's ever been. In previous bull markets, silver rallied primarily on monetary demand. Industrial demand was there, but it wasn't the driving force. This time, you have both monetary and industrial demand converging at the same time. That's unprecedented, and it's why some analysts are calling for silver prices that would have seemed absurd just a few years ago. Now, I want to address something important here, especially if you're someone who's been thinking about how to protect your retirement savings in this environment. The traditional approach of stocks and bonds isn't providing the diversification it once did. When everything moves together, you don't have true diversification. That's why more and more people are looking at alternatives, including precious metals. If you're sitting on retirement accounts with significant balances, there are strategies available that let you hold physical precious metals inside those accounts without triggering tax consequences. I'm talking about gold IRAs and silver IRAs, which are IRS-approved retirement accounts that hold physical metal instead of paper assets. I put together a comprehensive guide on how these work, what the rules are, and how to evaluate whether it makes sense for your situation. It's in the description below, and if you have over $100,000 in retirement accounts, it's worth taking a look at. No pressure, no sales pitch. Just information that could help you make better decisions about protecting what you've worked your whole life to build. All right, let's get back to the market dynamics, because there's another layer to this story that we need to explore. The behavior of the big institutional players in the silver market has been fascinating to watch. These are the hedge funds, the commodity trading advisors, the large speculators who move serious money. And their positioning has been shifting in ways that suggest they're preparing for something. If you look at the commitment of traders reports, which show the positioning of different types of traders in the futures market, you'll see that the large speculators have been building long positions. They're betting on higher prices. At the same time, the commercial traders, who are typically on the opposite side of the trade, have been reducing their short positions. When both groups are moving in the same direction, it's often a sign that a significant move is coming. But here's what's really interesting. Despite this positioning, the price hasn't exploded higher yet. It's been consolidating, building energy, coiling like a spring. That suggests that when the move finally comes, it could be more powerful than what the current positioning would normally indicate. The market is compressed, and compressed markets tend to make violent moves when they finally break. Let me tell you about a pattern I've observed in silver markets over the years. Silver tends to move in waves. It'll rally hard, then consolidate, then rally again. Each consolidation phase shakes out weak hands and allows new buyers to enter. The rallies get progressively stronger as more people recognize what's happening and want to participate. We saw this pattern play out in the great silver bull market that peaked in 1980, and we saw it again in the rally that peaked in 2011. The question is, are we in the early stages of one of those major bull markets, or is this just a cyclical rally within a longer-term bear market? The answer depends on which fundamental factors you think are most important. If you believe the industrial demand story and the supply constraints are real, then we're in the early stages of something much bigger. If you think the monetary factors are more important, then you need to watch what central banks do with interest rates and money supply. My view is that both factors are in play, and they're reinforcing each other. The industrial demand is real and growing. The supply constraints are real and not easily solved. And the monetary backdrop, with massive debt levels and geopolitical instability, is creating an environment where people want to own hard assets. When you combine all of those factors, the case for significantly higher silver prices becomes very compelling. But let's talk about the risks, because no investment thesis is complete without acknowledging what could go wrong. The biggest risk to silver right now is a deflationary collapse. If we see a repeat of 2008, where credit markets freeze and everything sells off in a scramble for cash, silver could get hit hard in the initial panic. It's happened before, and it could happen again. The second risk is that the industrial demand story doesn't play out as expected. If the global economy slows more than anticipated, or if technological changes reduce the amount of silver needed in key applications, that would undermine the bull case. It's a real risk, though I think it's less likely than the base case of continued strong industrial demand. The third risk is manipulation. Now, I know that's a controversial topic, and I'm not going to get into conspiracy theories here, but it's a fact that the silver market is relatively small compared to other commodity markets, and it's a fact that large players can influence prices through their trading activities. Whether that constitutes manipulation is a matter of debate, but the risk is that concentrated positions by large traders could distort prices in ways that don't reflect underlying fundamentals. Despite these risks, I think the risk-reward profile for silver at current levels is attractive. The potential upside, if the bull case plays out, is substantial. The downside, while real, is limited by the fact that silver is already well off its all-time highs and has strong support from both industrial users and physical buyers. That's a setup that favors taking a position, especially for investors with a longer-term time horizon. Now let's talk about what to watch for in the coming weeks and months. The first thing is whether silver can hold its current support level. If it does, and if we start to see buying pressure increase, that would be a strong signal that the consolidation is ending and the next leg higher is beginning. You'll want to watch for a decisive break above the recent resistance levels, accompanied by strong volume. That would confirm that the bulls are back in control. The second thing to watch is the behavior of gold. Silver tends to follow gold's lead, especially during the early stages of precious metals rallies. If gold breaks out to new highs, silver will likely follow with even more explosive moves due to its higher beta. The gold-silver ratio will be key here. If that ratio continues to compress, it means silver is outperforming, which is what you want to see in a bull market. The third thing to watch is the dollar. Silver and the dollar typically move in opposite directions. When the dollar weakens, silver tends to strengthen, and vice versa. Right now, the dollar is at a critical juncture of its own. If it breaks down from here, that would be rocket fuel for silver. If it strengthens, that would create headwinds. Let me share a historical parallel that I think is relevant to where we are right now. Back in the 1970s, silver went through a period very similar to what we're seeing today. The metal had rallied significantly in the early part of the decade, then consolidated for several years in the mid-1970s. During that consolidation, most investors lost interest. The excitement faded, and silver became boring. But underneath the surface, the fundamentals were building. Inflation was rising, confidence in the dollar was eroding, and industrial demand was growing. When silver finally broke out of that consolidation in the late 1970s, it went on one of the most spectacular runs in commodity history, rising from around $5 an ounce to $50 an ounce in just a couple of years. Now, I'm not predicting that we're going to see a repeat of that exact scenario. The circumstances are different and the market structure has changed. But the pattern is similar. We have a consolidation following a significant rally, we have strong fundamentals building underneath, and we have a market that's largely ignored by mainstream investors. Those are the ingredients for a major move. The key difference this time is the industrial demand component. In the 1970s, silver's rally was almost entirely driven by monetary factors and speculation. Today, we have legitimate industrial demand that's growing exponentially in key sectors like solar energy and electronics. That provides a floor under prices that didn't exist in previous cycles. Even if we don't get a speculative mania, the industrial demand alone could drive prices significantly higher over time. Here's something else to consider. The mining industry is struggling to bring new silver supply online. It takes years to develop a new mine, and the economics of silver mining are challenging because silver is often produced as a byproduct of other metals like copper, lead, and zinc. When those base metals are weak, silver production suffers even if silver prices are strong. That creates a supply-response lag that can lead to extended periods of undersupply. We're seeing that dynamic play out right now. Despite higher silver prices, mine supply hasn't increased meaningfully. In fact, some analysts are projecting that we could see supply deficits for years to come as industrial demand continues to grow faster than mine supply. That's a fundamentally bullish setup that could support prices at much higher levels than where we are today. Let's talk about what this means for different types of investors. If you're a trader looking for short-term opportunities, the current consolidation is creating a setup for a potential breakout trade. You'd want to wait for confirmation that the support is holding and that buying pressure is increasing before entering. Your risk would be defined by the support level, and your target would be the next major resistance level above. If you're a long-term investor who believes in the fundamental story, the current consolidation is an opportunity to accumulate at prices that could look very attractive in hindsight. You're not trying to time the exact bottom. You're building a position over time, taking advantage of weakness to add to your holdings. Your time horizon is measured in years, not weeks or months, and you're willing to ride out short-term volatility in exchange for the potential of significant long-term gains. If you're a retiree or someone focused on wealth preservation, silver represents a way to diversify away from traditional financial assets and hold something tangible that has maintained value throughout history. You're not necessarily looking for massive gains. You're looking for insurance against monetary instability and a store of value that can't be printed or devalued by central banks. Each of these approaches is valid, and the right one for you depends on your individual circumstances, risk tolerance, and investment goals. But regardless of which category you fall into, understanding the current market dynamics and the forces at play is essential for making informed decisions. Now, I want to circle back to something I mentioned earlier about the disconnect between paper and physical markets. This is becoming increasingly important as we move forward. The COMEX, where most silver price discovery happens, is a fractional reserve system. There are far more claims on silver than there is actual silver available for delivery. As long as everyone is content to settle in cash, the system works. But if a significant number of contract holders demand physical delivery, the system could face serious stress. We've seen glimpses of this in the past. There have been periods where delivery requests spiked and the exchange had to scramble to find metal. Each time that's happened, it's created upward pressure on prices. If we reach a point where confidence in the paper market erodes and people start demanding physical delivery en masse, we could see a price spike that makes previous rallies look tame by comparison. This is why physical ownership matters. When you own physical silver, you're not exposed to counterparty risk. You're not dependent on someone else's promise to deliver. You have the actual metal in your possession or in secure storage. In a world where financial system stress is a real possibility, that distinction could become very important. Let me share one more historical example that I think illustrates the potential of what we're looking at. In 2010 and 2011, silver went from around $18 an ounce to nearly $50 an ounce in less than a year. That rally was driven by a combination of factors: quantitative easing by central banks, concerns about sovereign debt in Europe, and a surge of retail investor interest driven by social media and online forums. The rally eventually collapsed when the exchange raised margin requirements multiple times in a short period, making it more expensive to hold leveraged positions. But here's the interesting part. The fundamental drivers that sparked that rally never went away. Central banks continued printing money. Debt levels continued rising. Industrial demand continued growing. The rally ended not because the story changed, but because of technical factors and profit-taking after a parabolic move.